The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Christina Aquino. We are kicking you off to the closing bell here in the U.S. And so let's take a look at where markets stand less than an hour into the closing bell. We got to take a look at the Nasdaq Composite. Of course, that is the epicenter of the sell-off today and really for the rest of the week. At the moment, down 0.4% at the moment. So pairing some of those earlier losses. Bitcoin also having a bit of a rally today. That's up more than 2%, but it did lose 300 billion wiped from its value this week. So let's see if that rebound continues. On the day of today, we got to take a look at gold, of course. That is a haven that is gaining today, up 0.7%. Still enjoying a good base of support from both institutional investors and retail traders. And of course, Take-Two, one of the biggest decliners on the S&P 500 today because the Grand Theft Auto 6 release has been delayed again. Shares down more than 7%.
Yeah, bad news for gamers if you were anticipating it right away, but maybe good if you are looking to buy for the holiday shopping season in 2026. All right, back-to-back losses, leaving the U.S. stock market ending its 3-week winning streak. The Nasdaq now on track for its worst week since April, when President Trump announced his reciprocal tariffs. Investors are going risk-off as they grapple with economic angst, tech pullbacks, and CEO warnings about froth, all as earnings season continues to come down to a simmer.
I think that as the earnings season gradually comes to an end, we'll be looking at what the individual companies are saying about the household.
And at the heart of it all, an anxious consumer. A New York Fed survey finds Americans' perceptions of the job market getting worse, while the University of Michigan's latest consumer sentiment index tumbling to near the lowest on record as the government shutdown starts to erode confidence. The shutdown is already the longest ever and resulting in coordinated flight cancellations. Transportation Secretary Sean Duffy warns that flight cuts could now reach as much as 20% due to staffing shortages in air traffic control. We'll have a live report from Newark Airport in the next hour. But first, let's get back to markets and kind of frame where we are for the day and for the week. And kick things off with Afsaneh Beschloss. She is founder and CEO over at RockCreek. Afsaneh, it is great to speak with you. I just want to get your take here in terms of the sentiment and how we seem to have shifted from a glass half full to a glass half empty this week.
Great to be with you. I think what is happening is really this two-tailed city of the economy and the market are persisting and getting more divergent. So what we're seeing is that on the one hand, anything related to AI that had this incredible growth in terms of value. We saw like 164% since OpenAI started, increase in those stocks. And we saw only 24% increase in other stocks, which is a really big difference. Really sort of start to get corrected this week, right? As people got nervous, as you just said, and saw the valuations being high. Even the utilities, even stocks like Constellation, were affected. So anything impacting AI, data centers, energy was impacted, except maybe a little bit in oil and gas. And people are getting nervous about this sort of fraudy market. People are selling even private positions, not just public positions. You're starting to see some of that, or not allocating a lot to privates. So across the board, the markets are seeing more volatility. The VIX index is a little bit higher. At the same time, I think in the last 10, 15 minutes, with Senator Schumer coming to talk about maybe there might be an agreement to bring the shutdown to an end, starting to turn the market around a little bit. I think we need to see a lot more in terms of what the details on that are. It's a little bit too soon, but people obviously have been impacted by the shutdown, by that consumer sentiment number that you said also.
Yes, absolutely. And for now, it's showing up in sentiment. But at what point, Afsaneh, does the shutdown threaten fourth quarter growth, whether it's in earnings or in the economy? How are you thinking about that?
I think generally economists would say that shutdowns, whatever you see in impacted, and we've seen a lot, whether you're using sort of large numbers that we have seen Bloomberg use in terms of the shutdown per week, come back and get corrected for in the following month or two. I'm not so sure if that's going to be the case. I think that a lot of people who are not holding stock markets, they are not investors in the stock market, are really starting to get nervous about their jobs. We've seen the jobless numbers. We've seen the layoffs that are starting to happen. So it doesn't mean that the shutdown is stopped and people start spending, because I think that nervousness and that sentiment will go on. Plus, affordability hasn't changed, right? The price of health will still be high, regardless of these agreements. The price of housing is still very high. The price of food is very high. I think the administration has been thinking of the price of gas. Maybe that's just one commodity, but all the other prices are high. They're not going down.
Yeah, well, as you mentioned, Afsaneh, the consumer sector definitely struggling at the moment. But then at the same time, we have had a market that's been driven so much by expectations for AI and all these deals that we've been seeing. A K-shaped economy, as you mentioned. Where do you think kind of that divide bridges the gap, and which sector do you think will feel more pain if there is kind of a reconciliation coming for both sectors of the economy at the moment?
I think on the positive side, I think things that get impacted by AI, but not necessarily building the big data centers, but the applications and the uses part of that economy will continue to do well, because I think we're still in the first innings as far as AI is concerned. So while that huge infrastructure cost that we see getting built may get impacted, the other parts of services to the that are coming around and applications will benefit. On the negative side, I think consumer goods will get impacted, not just because of what we're seeing with layoff and with the efficiencies that are coming into the market in middle management, as well as in other white-collar work, but also the fact that we're seeing the permitting, for example, was delayed, IPOs delayed. So all of that is not going to help us start getting the employment that was originally intended by the administration into manufacturing.
And are you worried then about the possibility that we may be seeing a bit of a bubble growing here in the AI space? Is that something that you're worried about bursting potentially at some point toward the end of the year or maybe early next year?
I think no question there will be some sort of correction, whether that correction is at the end of this year or next year, or it takes even longer to correct, just like we saw with other bubbles in the internet market. Nobody can call the time. But I think the point of that, though, is that it doesn't mean that those things, while they're a bubble, they're going to still impact the market, the economy positively, right? If they impact the economy positively and cause growth in the economy, that will have a positive impact eventually on the markets as well. So I think we have to be careful to sort of look at the impact, the negative and the positive at the same time. And frankly, I don't think anyone has an answer to that question.
Absolutely. I mean, it's just speculation at this point. What we have seen with the government shutdown is a tightening of financial conditions. We're seeing stress in money markets, and I wonder whether this will have consequences for the credit market, which leads all the other asset classes.
Absolutely. I think we should watch the credit markets. We're seeing already car loans, other kinds of loans that are starting to have some problems. We're just seeing more problems in terms of payments. It's not of the scale that we saw around the time of the financial crisis because of the regulation that was put in place. But no question that is starting to impact a lot of people. And depending on what how the ACA gets impacted, if it's solved in the next week or two, maybe things will be different. Otherwise, we have to add on the debts that will be added on in terms of medical costs.
Yeah, already to a pretty hefty debt bill there. Afsaneh Beschloss, thank you so much for joining us, founder and CEO over at RockCreek. We do have some breaking news here. While we're speaking with Afsaneh, the Republicans have rejected an offer from the Democrats to end the shutdown. This is according to a Republican aide. We're looking at indexes, at least for the S&P 500, come back down just a little bit. It's off by 0.1%. And this is after the Democrats had offered a one-year Affordable Care Act subsidy renewal in this shutdown battle. So again, Republicans rejecting the first offer from Democrats to end the shutdown. We'll keep you posted on further developments. I suppose the good news here is that the two sides are talking. All right, coming up, we are lifting the hood on the auto sector as concerns rise about hidden cracks. We're going to discuss this with Erin Keating, executive analyst and senior director of economic and industry insights at Cox Automotive. This is The Close on Bloomberg. First Brands winning access to a $600 million lifeline. These are emergency funds that save the auto parts supplier from liquidation. Our next guest says money problems at First Brands, along with two subprime auto lenders, should stay relatively insulated. Erin Keating is executive analyst and senior director of economic and industry insights at Cox Automotive, and she joins us now. So, Erin, we also learned this week that used car retailer CarMax cutting its guidance and now sees comparable sales falling 8 to 12%. It would appear that all of this is evidence of difficulties in the lower tier auto market. What are you seeing?
I mean, for sure, we know that affordability has been one of the top issues for the automotive industry for a couple of years now. And we've seen our average transaction price for new vehicles finally reach and crest over that $50,000 limit. But we aren't seeing anything that's immediately causing us to think that there's some sort of crisis in the system. A couple of these bankruptcies and liquidations are fairly specific to the area that they focus on. CarMax, they've just been in the industry with a couple of different tactics that perhaps need some pivots. We're experiencing much more need for omni-channel experiences, meaning that customers can go live in person as well as stay digital when they're looking for vehicles. And looks like CarMax might need to right-size some of their transformation plans. But still, we're not seeing the data that says that we're in any kind of crisis for the industry.
I understand what you're saying, but you look at First Brands, Tricolor, and Prima Lend all filing for bankruptcy, and yes, there's specific one-off issues. There might be fraud there as well, but what does it say when mismanagement is a common theme here, and they're all imploding right around the same time?
Sure. I mean, again, mismanagement is, I think, important to remember that is a primary cause of some of these quote unquote implosions at some of these companies. So from that perspective, I think we need to just remember to keep them relative to what's happening in the overall landscape of the automotive industry. And right now, delinquencies and defaults are fairly stable. We're not seeing something really getting into destabilization territory with that. So I do try to stay closer to that language around somewhat insulated, occurrences in the industry. CarMax is a little bit different, but not necessarily signaling the same thing that the different lenders are experiencing or that First Brands is experiencing.
Now, Erin, I do want to dig a little bit into CarMax since we did get their results yesterday. A lot of disappointment there from analysts, warning of margin pressures. Do you think that some of the changes that they've announced or are implementing, is that going to be enough for them to be able to mitigate some of those affordability concerns that analysts have raised?
I think that they've heard the signals from the market pretty clearly. Again, they've had a history of really requiring people to come in person, especially when it comes to trade-ins and acquiring used vehicles at their lots. And I think that there's just a tendency towards customers really wanting to be able to do a lot of that work online beforehand. So when you're consistently pushing customers into channels that are not necessarily where they want to be, you're going to face not only a used car acquisition challenge of getting newer vehicles into your inventory, but you're going to have customers who are going to look for alternative solutions. And CarMax certainly has quite a few competitors in the market, namely Carvana being one of them, that is really progressive in this area.
Yeah, well, you mentioned Carvana, of course. I wanted to ask you as well, what do you make of their strategy shift? They are seeing pressure from competitors such as that. Is that going to be enough to kind of fend off some of these other companies that are trying to steal their market share here?
Yeah, I mean, I think competition is always great, and it always spurs on some new and different ideas for the companies who are really starting to lose market share. So I'm confident they've been successful for a very long time. CarMax is a very well-known household brand, especially for the used vehicle market. And so long as they really focus on getting to where the customer is, I think that they will likely be able to pull through this and at a minimum maintain share for themselves. Again, the digital experience for customers is becoming more and more important, and also what these companies are choosing as their acquisition methods to get newer vehicles. I mean, CarMax does have more of the 5 to 10-year-old vehicles in their inventory. And as we're cresting this moment where new cars are getting so expensive, people are trying to come into that 1 to 3-year-old market. And we just know that there's a dearth of those available to us right now. So being real strategic and making sure that you get those aged vehicles into your inventory is going to be important.
Right. So some supply constraints around that favored 1 to 3 year old vehicles
Yes.
that people do want. I want to go back to what you were saying about auto loans. Delinquencies on subprime auto loans is increasing. And I remember in the years around the great financial crisis, the performance of auto loans was actually more telling than mortgages because the last thing people would give up on was their cars. They don't need their house necessarily. They don't have to own their house, but they did need their cars because they needed to get to work. And that's how they would make their living. At what point do underperforming car loans become a bigger concern, become even potentially a crisis this time around?
I certainly think that they would need to get to a much higher default rate. I think that's a very indicative market, and we are still well below the great financial crisis numbers as far as defaults go. And we've seen that credit is honestly loosening. Obviously banks and lenders are becoming a little bit more open about making lending available. So I think that for now, rates are the biggest issue. We do need them to come down. Even though the average transaction price is getting higher and higher, it is pretty much on trend for where it should have been at this point, as it were. It's the monthly payment that are really difficult, especially for subprime buyers and near prime buyers. The monthly payment is a lot for them to swallow. And so if interest rates keep coming down, if the Fed fund rate moves, and then the banks loosen up their credit availability, I think we will see us stabilize in this area.
All right, good stuff. Erin, really appreciate it. Erin Keating is the Executive Analyst and Senior Director of Economic and Industry Insights over at Cox Automotive. And staying with car makers, we want to make a correction from earlier on Bloomberg Television. We accidentally said Tesla's goal was to make 20 million vehicles annually. We should have said that that is over the next decade. Now, coming up on the close, airline stocks are hitting some turbulence as flight reductions in the U.S. begin to impact travelers. We'll take a closer look at those stock moves up next. This is The Close on Bloomberg. It's time now for our top calls that look at some of the big movers on the back of analyst recommendations. And let's start things off with Sweetgreen. William Blair going sour on the salad chain with a downgrade to market perform. The cut reflects the third quarter miss on earnings and a lack of visibility on the timing of a turnaround. The stock plunging 10%. Up next, Datadog. They say every dog has its day, and today, Datadog receiving a pair of upgrades from KeyBank and Guggenheim. The firm's turning bullish on the back of the software company's earnings and believe growth will continue. The stock down about 0.75%. And finally, Expedia. Piper Sandler's rating is taking flight as they raise the online travel platform to neutral and increase their price target to $250 from $190. Following a very strong third quarter, the analyst adds that bookings are accelerating and management is getting sharper. You can see the stock defying the rest of the market, up almost 20%. And those are some of our top calls. Let's stay in the travel sector and get a check on airline stocks, because today is the first day of the FAA implementing flight cuts at 40 key airports across the nation due to staffing issues brought on by the ongoing government shutdown. Here to discuss is Bloomberg's chief correspondent of global aviation, Siddharth. Philip and Sid, I want to start with the board that we just showed, which indicated the carriers, the legacy carriers, are all higher on the day. Just walk us through why that might be.
So the impact of the cuts hasn't quite yet hit the airline industry. I mean, if we look at the number of cuts today, we've had about 780 cuts out of 25,000 flights. So it's really a drop in the ocean in terms of the actual impact on airlines. I mean, most airlines have said that they're running regular schedules and they're running most of their regular flights. So we haven't really seen much impact. That said, I mean, the government just came out and said that they could have to cut even more flights if the staffing levels require it. And so that could be something of a concern for the airlines. But at the moment, the cuts don't look like they're having much impact on the number of flights that they operate.
Yeah, well, Sid, very interesting, because we did also hear from U.S. Transportation Secretary Sean Duffy saying that these cuts will continue to grow, right? We could see cuts of up to 10, 15, 20% heading into next week. And of course, we are heading into peak travel holiday season for the U.S. as well. So when do you think these cuts will start to bite for these airlines?
So, I mean, it will start to impact the airlines as they get bigger and bigger. So we're starting with a small number. We're starting with about 4% on today, that's Friday. And we will go to about 10% by the end of next week. And we haven't really got a sense from the government yet as to when those increases that they've threatened to go beyond the 10% will actually come into place. And that will sort of have an impact on the airlines, because once we get into territory where you have 10, 15, 20% cuts, that's actually a significant portion of the flights that the airlines fly. And that's really going to hurt their bottom lines.
Sid, I realize I'm going to ask you something that might be unanswerable, but what do we know about what this FAA order means for private jets and smaller airports that serve these private jets? I'm guessing that, they're not part of the list of 40 airports that are directly impacted, but there might be some spillover.
So there is spillover, and yes, Teterboro, which is one of New York City's most important private jet airports, is in fact impacted. It's on that list. And so we're going to see some impact on private jet travel, especially into airports where you're already sort of jostling with commercial aviation. So not every private jet flies into a private jet airport. I mean, they have to fly into regular commercial airports. And in those airports, they're going to see far more impact from those cuts. And so we don't really know how they're going to sort of cut those flights. We don't know which private jets will be prioritized and which ones will be forced to sort of fly to alternative airports. But we will see some impact there as well.
Yeah, now, Sid, I also want to take a look at some of the secondary impacts of this shutdown, right? Where we're talking about lost jobs, lost incomes, and that, of course, adds to pressure for consumers in U.S. households, potentially feeding into travel demand. Do you get a sense from the major airlines that this is something they're potentially thinking about longer term, and how might we see that impact down the road?
We've seen some comments from the airlines, including Southwest Airlines, talking about how they do worry about demand, especially as we go into the busy travel season when people typically, when they tend to visit their families over Thanksgiving and Christmas holidays. And we are beginning to see concerns from the airline CEOs that those people may not actually go and take those holidays. And that actually has an impact on bottom lines. And so while Delta and United have talked about how they're reliant on the premium travelers, some of the other carriers are reliant on the back of the plane, and that's where there are concerns about how that's going to play out. And the longer this drags on, it might have an impact on those travelers and those consumers.
All right, good stuff. Bloomberg's chief correspondent for global aviation, Siddharth Phillip, joining us there as we talk about these airlines that are, of course, cutting their flights. Right now, it's in small stages, right, Christine, because it's going to start at about like 3%, then increase to 4%, over time get to 10%. But Sean Duffy has warned maybe we could reach as much as 20% over the next couple of days.
Yeah, absolutely, Scarlett. And as we mentioned, that's going to be peak holiday season, right? A lot of travel plans probably going to be disrupted by all of this.
So if you're going to make travel plans or you're going to change them, right now they're waiving all the change fees. This might be a time to do it, but I mean, anything could change on a dime here. This is Washington we're talking about. All right, coming up on the close, Celsius shares up almost 65% so far this year. We'll speak to the CEO next, John Fieldly, about its recent acquisition of Rockstar Energy. This is the close on Bloomberg. It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Christina Aquino.
And usually around this time of the day and week, I've had several cups of tea because I need to make sure that I'm ready to go through the afternoon. What's your caffeine of choice?
Well, it's iced coffee in the morning or hot tea.
Okay.
It has to be iced coffee or hot tea.
So no energy
the other way
drinks?
around. No, I'm not really a big energy.
Well, you're also not a teenage boy. I mean, that's just kind of the natural audience for a lot of the energy drinks. And this is based on, unscientific evidence like my own family life. But in any case, it's fascinating because the energy drink has really gained a lot of attention, certainly a lot of fans. Our producer is a big fan of Celsius, for instance.
Yeah, I mean, it seems like it's really capitalizing on this whole idea of convenience, right? It's something that you can grab and go versus, I guess, trying to get a coffee, you have to line up, you have to wait for the barista to put it together and put the finishing touches. Like some people just don't have time for that.
But there's a culture to that. There's a cafe culture. What's the energy drink culture?
Yeah, I mean, apart from teenage boys, maybe, people who go to the gym a lot.
That might be one of them. All right, well, here now to discuss the energy drink market and his company is Celsius CEO John Fieldly. John, it's great to speak with you. Before we get to the energy drink culture, I just wanted to go over your results with you because this week you reported third quarter revenue that beat the average analyst estimate, but not the highest buy-side consensus. And I recognize that there's weakness in the overall market, but you look at Celsius shares and they're extending yesterday's plunge and now set to close the week down about 30%. What do you think investors are not giving Celsius enough credit for?
Yeah, no, glad to be here. We're really excited where we're at. It's been a transformational year for Celsius. We just completed an acquisition of Rockstar, and also Alani Nu this year. So we have a lot going on, and the fundamentals of the business have never been stronger. We did beat the street, not only on revenue, but also EBITDA, came in at 200 million in revenue and EBITDA. But what we did say is Alani is going to be integrating into PepsiCo's distribution system. And we just signed a new deal with Pepsi, which further enhances our capabilities. And we are the energy lead captain for PepsiCo, which we're really excited about. But the timing of that, and some of the orders that will be transitioning from Q4 into Q1 of next year. But we're still very disciplined on the execution and how we're going to bring Alani into the distribution network, which would be majority of those distribution partners. And our outlook has never looked brighter. We got great innovation, and we're really excited. So I think it's just a mismatch on short-term expectations, but we put up solid results, and we're really excited about where we're going. And this is a fast-growing category, and we have some of the best brands in the category.
You mentioned the Alani Nu brand transitioning into PepsiCo's distribution network. Does that, it's created this distortion, this short-term mismatch, as you put it. Does that extend to other brands as well within the Celsius portfolio?
No. Actually, the Celsius portfolio has, we're up to about 13% growth rate, growing faster than the category. And inconvenience, which is a really important channel in the energy category, is also exceeding expectations and the category growth rate. So we're really excited about that. Celsius is doing well. We just launched a campaign this year called Live Fit Go, really aspiring people to live a healthy, active lifestyle and really use Celsius to help you achieve your goals. And then Rockstar is already in the PepsiCo distribution network. It's been a struggling brand. It's original OG energy. We do see great value in that, going back to music and culture and having people accomplish be their inner rock star. So we're really excited about that brand.
Now, John, I'm glad you mentioned some of your push into the health segment, trying to target more health-conscious consumers. Talk to us more about that, because Scarlett and I were just talking about, there's a whole culture around that and coffee drinking as well that perhaps Celsius could eat into. Would the health-conscious consumer perhaps be your way into creating that sort of culture?
Yeah, 100%. And that's what's unique about Celsius and Alani. They're really multivitamins in a can, really providing that better for you energy to help you go through your day. You talked about afternoon pickup. What's better than a refreshing Celsius or Alani? Some fun, great flavors. With Celsius, we just launched a Spritz Vibe. This actually 2 weeks ago. It's a variety of fine retailers. It's great. It's fun. And then with Alani Nu, we have a Winter Wonderland flavor that's kicking out in the retails right now, which is another exciting flavor. Expanding the category, health and wellness is continuing to grow, and consumers are looking for something that's aligned with their healthy, active lifestyles, and that's in the DNA of Celsius and Alani.
Yeah. And what are you thinking in terms of the consumer outlook, John? Because we know, of course, there's a lot of stories about consumers coming under pressure, especially heading into the end of the year. But, is this something that, spending on their health and maybe choosing a healthier drink, is that something that you think would be a priority for them, despite the fact that their income might be under pressure from a bunch of other catalysts here?
Yeah, I think you're spot on. What we've seen is really strong growth within the consumer segment, especially in energy. The category continues to grow double digit. We expect that to continue into 26 and beyond. It's a growing category. Consumers want more out of the beverages they consume. They want more out of their energy drink, and Celsius and Alani deliver that with the functional vitamins that are in these products and within their vitamin blend formulas. So also, as you're heading into the holidays and you're getting ready for Thanksgiving, you got those turkey trot runs and 5Ks. What's better than to grab a Celsius or Alani and get going? And if you're going shopping, you're going to need the pickup. And there's no better other product on the market.
Well, to Christine's point, I'm sure you've noticed that earnings from fast casual restaurants show foot traffic stalling, especially from young people, while fast food restaurants are doing well and continuing to do well because consumers are seeking value. What's the takeaway for Celsius in terms of offering a breadth, a range of price points for consumers who are becoming very, very budget conscious?
Well, I think when you look at energy drinks in general, it fills a need state. It's it's part of a daily lifestyle, a daily routine. And you're looking at some of those coffee houses that offer also refreshing, cold, caffeinated beverages. When you look at some of the price point versus a Celsius and or Alani or a Rockstar, we're great value, great flavor, and great energy as well. So I think we could pick up some additional share from that. Also, Evercore came out with a report that talked about how the energy category was taking share from cold brews and cold coffees. So So that's that's what we're seeing in the category, and that's probably why the category continues to grow.
Yeah, well, John, any insight into perhaps the international market that you may be targeting? I tell you, I used to live in London. I was there for 9 years, and I'm sorry to say that Monster has the market over there, but any plans for potential try and take over the market share there?
100%, and we're just getting started. The same health and wellness trends we see in the U.S. are global trends. We actually have a great share presence in Sweden and Finland, very healthy markets. And then also we've just recently launched in Australia, seeing great results there. We just launched in the U.K. And New Zealand. We also France and Benelux. So slow starts, methodical approach, but we're really excited. And Monster does have a stronghold, but we see great opportunities, and we're going to bring some refreshing energies to the market.
John, great speaking with you. Before I let you go, I have to ask you about aluminum tariffs. I know they've been a headwind. What do you see the impact in the fourth quarter? Do you see them increasing? And, you know, what does that say about how things shape up for 2026?
Yeah, I mean, we produce locally in the markets, but we do import, and you know, aluminum tariffs have been a challenge, especially with Midwest premium prices on aluminum. So it's something we're going to have to deal with. We're trying to leverage pricing, promotional strategies as well to offset that. If you saw the gross profits we delivered in the most recent quarter, we're really focused on discipline here and driving profitable growth and earnings. So it's a headwind we're going to have to deal with. We do expect it to continue, especially as we FIFO through some inventory that we have on our balance sheet.
All right, good stuff. John, thank you so much for joining us today. Really a pleasure speaking with you. John Fieldly is CEO of Celsius Holdings. We're going to stay in the beverage and food sector because coming up, Wendy's delivering a smaller than expected sales loss in the third quarter as consumers, as we've been saying, this is a theme here, they're cutting back on spending. So we'll serve up the top items to watch for in today's Stock of the Hour. This is The Close on Bloomberg. Wendy's serving up a smaller than feared loss on comparable sales in its third quarter earnings report. The consumer read-through indicating that folks are cutting back with particular weakness in the lower income cohort. It's a familiar story. We've seen it across different sectors. Joining us now is Michael Halen, senior research analyst at Bloomberg Intelligence. Michael, is this what we're seeing at Wendy's, the ideal outcome from a well-executed, well-thought-out strategy, or is it just benefiting from consumers flocking to fast food and value?
Well, I guess the first thing is let's not confuse the price of the stock and the price action with results. So the results were bad, and they're going to be bad again in the fourth quarter. The stock is up because it's been taking a beating for about a year and a half. So kind of get that out of the way. Now moving forward, they've kind of slowed down the pace of innovation and are kind of trying to improve the operations and get this marketing plan lined up, right? This is their turnaround plan for next year. They're going to also close some underperforming restaurants. I think they made a really smart move hiring Greg Creed, who is, you know, arguably the GOAT of QSR CEOs to help consult with that business, right? And so they're saying the right things. We think there's a chance for sales to inflect higher in the first half of next year, but there's going to be continue to be pain you know, through year end. A lot of it in this case is self-inflicted, and yes, also due to lower income consumer spending.
So, Michael, safe to say you're skeptical of the future of Wendy's, but, you know, talk to us about some of the things that they're trying to do to improve on this, right? They're trying to improve foot traffic. They're introducing Wendy's tendies. Are these things going to be enough to bring back some of those customers that they're really trying to capture here?
You know, I think next year they can grow same-store sales, you know, and they're doing it, like I said, they're saying the right things on the call. They're trying to fix the operations first, you know, make sure that they're serving food quickly, hot, with a smile on their face, and boosting customer satisfaction so that they come more often. Once you get the operations nailed, then you can start turning on the marketing. This company is a great brand. They have a lot of marketing equity. You know, I talked about, you know, Where's the Beef and some of the other campaigns that they've done in the past. Like, Wendy's is really a great brand that there are a lot of people that absolutely love Wendy's. And so I think there is potential here, right?
Yeah.
But there's also a lot of work to be done.
Absolutely. I'm just looking at a headline that just crossed. President Trump asking the DOJ to probe meatpacking companies, and we're seeing shares of Tyson erase their gains. I recognize that Wendy's is not directly impacted, but is there kind of any spillover effect from these kinds of government actions into meatpacking companies that would increase prices for the likes of Wendy's or other restaurant companies?
You know, it could. I mean, listen, beef prices are very elevated. You know, Texas Roadhouse was talking about 15-ish% beef inflation in the fourth quarter. Luckily for Wendy's, however, they're 95% franchise. So the 5% of the stores that they own, they're going to feel this, you know, in their restaurant level margin. But it's the franchisees that are largely going to foot the bill for the higher commodity prices at Wendy's.
Although if they want to be generous, they could help out their franchisees as well. Michael, always appreciate it. Thank you so much. Michael Halen, Senior Research and Restaurant Analyst over at Bloomberg Intelligence. You're a fan of Wendy's. What was your favorite product?
I love Wendy's. Frosties, all the way for me.
Yeah.
Fries in a Frosty.
Did you dip your fries in the Frosties?
Of course. That's how you should do it. That's the only way to do it.
The only way to do it, fries and Frosties. All right, coming up, we're going to take you to the closing bell with Callie Cox. She is Chief Market Strategist at Ritholtz Wealth Management. Keep it here. This is The Close on Bloomberg.
We're still in the first innings as far as AI is concerned. So while that huge infrastructure cost that we see getting built may get impacted, the other parts of services to the that are coming around and applications will benefit.
That was Afsaneh Beschloss, founder and CEO at RockCreek, kicking off the show here as we look at a market that has come back off of its losses. The week, however, is still very much in the red.
Yeah, so much to unpack here, Scarlett. I mean, a lot of it, of course, led by the tech sector, right? A lot of questions over valuations there, circular funding risks, especially because we've seen a ton of AI deals coming through in the pipeline. And now investors are probably wondering, how much more can we go?
Absolutely. And you look at what's happening today, Bitcoin has traded really like a risk asset, moving in tandem with equities. And today it's higher. I know 2.7% is like a nothing move for Bitcoin, which tends to move in much, much larger amounts. But it's really interesting to see how the sentiment on risk assets has really shifted over the last couple of days.
Yeah, that's true, Scarlett. And, I think just because we're in a government shutdown and, we don't have official data, we have seen a number of indicators that seem to have really propelled that shift in sentiment that you're talking about, right? We did see some inflation indicators indicating that perhaps inflation risks are still lingering, particularly for companies. And then, of course, some not so great job numbers. And I think that combination really just kind of giving investors reason to pause when perhaps they were looking for one anyway.
That's a good point. Anecdotally, we know that there's a lot going on with companies from Target to UPS to Amazon announcing big layoffs. We don't know when they'll take effect, but it certainly weighs on sentiment. For more market analysis, let's welcome Callie Cox. She is Chief Market Strategist at Ritholtz Wealth Management. And Callie, I want to start on the shutdown because we were down, we were seeing losses today, and we've come back up off of our lows. And in fact, the S&P 500, the Dow, kind of little change at this point. Is that what's missing, the catalyst of the government shutdown being resolved for the market to resume its path as from before?
Yeah, I think the government shutdown is becoming more and more of a risk. I think when the FAA's announcement about canceled routes hit the news, I think it shocked a lot of people into realizing that there could be some worse growth outcomes that come out of this, especially for certain sectors like airlines. And as this shutdown compounds, I mean, we're in unprecedented territory right now. This is the longest shutdown in history. And we're giving up a lot of things along with it. SNAP benefits, we're giving up federal worker paychecks. That can weigh on growth. And we expect a lot of that growth to snap back once federal workers get back pay, but that's not always a guarantee. And the permanent damage just accumulates as the longer this goes on.
Yeah, and I could see how that's already showing up in just the way that people react to news. What is your take on the University of Michigan sentiment numbers, which show that overall sentiment is down near the lowest ever, and the inflation numbers, at least for the short term, as Christine was mentioning, seem to show that price pressures remain with us?
I'm not too shocked by that, although I don't like the combination of lower confidence and higher expectations around inflation. And add into that, too, worse expectations around unemployment and finding a job. You see that in the conference board data. That's the gauge that I like to follow. You see it, today we saw it in the University of Michigan data. We're dealing with a really toxic mix of conditions within the economy. And for now, it doesn't seem like they're hitting growth or confidence too hard, but it is, tying the Fed's hands behind its back when it comes to interest rates. And it's throwing the market for a loop in trying to understand exactly where this economy is, especially as we stumble around this dark room with a blindfold during the government shutdown.
Yeah, well, speaking of a dark room with a blindfold, I mean, today was meant to be a jobs day today, Callie, but we are surprisingly empty on the calendar because, again, we still have the shutdown going. But, talk to us a little bit about what you're seeing in the labor market. We have seen some signs of weakness there. And, of course, the Federal Reserve indicating at their last meeting that perhaps it may be time for a pause. But if the job market deteriorates further, do you think that might change the minds of Chair Jerome Powell and the rest of his colleagues?
Yeah, well, the Fed is stumbling around the same room, given it does have more economists working on behalf of it. So I'll give them that. They probably have as much of an edge as anybody here. But, if you look at the job market, you're getting a lot of mixed signals. You're getting less hiring, which could be a supply issue. It could be a demand issue, companies cutting down on jobs, but then also not being able to hire because the labor supply is essentially stagnant right now. What worries me is that we're seeing signs of layoffs picking up. Obviously, we had that Challenger job cut announcement data yesterday that shocked everybody. One of the highest monthly totals of job cut announcements since COVID, I believe, since July 2020. Job cut announcements, though, are not actual layoffs. It does point to the fact that layoffs may be coming, especially in the fourth quarter. And if we do have more layoffs, or at least increased layoffs, that could upset the balance of the job market enough to, push it into another phase of a slowdown.
Yeah, given that this is the backdrop that we're at when it comes to the labor market and just looking at market expectations, for instance, for the Fed's last meeting of this year in December, we have about 15 basis points priced in terms of rate cuts there. Where do you think the risks lie? Do you think that markets are actually underpricing or overpricing the potential for another rate cut, a final rate cut in 2025?
This is going to sound weird based on what I just said about the job market, but I think they're overpricing the chance for a rate cut because the Fed, we just talked about inflation expectations. Inflation itself is hovering around 3% year over year. It's boosted by goods and services, and the Fed is worried about the services side of that equation. And we did see dissents. One thing that keeps sticking out in my mind is the fact that we saw dissents on both sides of the aisles in the last Fed meeting. We got Stephen Moran advocating for a 50 basis point cut, but at the same time, we had another president advocating for no cut. So I really think it's a toss-up on if we see more rate cuts heading throughout the end of this year. And even if we do see a rate cut, I don't know if we see much more than that. And I'm not sure markets are ready for a Fed pause here.
Callie, Bloomberg has a Markets Pulse survey that shows the shutdown is really dividing people on how to react, what to do with their portfolio. Half of those surveyed say they would position by buying havens or hedging equity downside through options. The other half say they would just prefer to keep buying stocks and pretty much ignore the shutdown and count on the fact that things will bounce back. What do you think?
I'm not sure you can ignore this shutdown. We talk to long-term clients. I also don't think you should change your long-term strategy based on this. I think the right move right now is to consider what you would do if we saw a 5 to 10% pullback on valuation, on shutdown concerns, on job market concerns, which could push us to more and more of a pullback. You can't fight a bull market. That's the bottom line. And right now we are seeing a lot of buying activity, when markets dip a few percentage points. So understand that you need to be a little more tactical here. You probably need to make a plan for if we do see a larger pullback. And that plan can look different for everybody. But, just prepare for one before you're thrown into that situation. All
right. Well said. Callie, thank you so much for joining us. And by the way, congratulations. Callie Cox is going to be having twins fairly soon. Callie Cox, Chief Market Strategist at Ritholtz Wealth Management. We're moving closer to the closing bell. We've got full market coverage right here on Bloomberg across our platforms.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We
We are about 2 minutes away from the end of this trading day and trading week. Scarlett Fu and Christina Aquino here in for Romaine Bostic and Katie Greifeld. And here to take us through the closing bell, we've got a global simulcast, which means Carol Massar and Tim Stenovic are on board. And together we bring all of our audiences across Bloomberg Television, Bloomberg Radio, and YouTube worldwide to parse through the most crucial moments of the trading day. Maybe it was in the last hour when we have turned positive because there appear to be signs that the two sides in Washington are talking to each other.
Maybe. Or aides are, or something.
They're talking to each other very publicly.
Or
through
something.
the media, or they're making speeches.
Are they really having meetings?
I don't know if they're having meetings with each other.
All I will say is look at something like the airline stocks. They've been down as much as 2.6%, up as much as 3.8%. Right now, just off their highs, again, about 2.3%. We know what's going on with airlines. We've seen reduced flights, problems at airports, but hopes of maybe the shutdown ending and getting back to a normal flight schedule has airlines rallying. So it's been kind of a wackadoo day.
It has. Next week, we're going to get more information. Not necessarily from the U.S. government. Today was supposed to be a jobs day, and traditionally we'd be talking about that jobs report, but we're not doing that today. Instead, I'm going to look ahead to the earnings that we're going to get next week. We'll hear from Walt Disney. We'll hear from CoreWeave. We'll hear from Paramount Skydance. We'll hear from, we'll also hear from Warner Brothers Discovery, or rather Maple Bear, Instacart. We're going to get C as well, and kind of a tech check as well, right? With Cisco. Yeah, very busy.
Yeah, well, Tim, I'm looking at the sectors that are leading and lagging today, of course. As expected, it is definitely the infotech sector dragging the index down, and the S&P 500 set for its worst week in a while. So very much expected, given the tech-led sell-off we saw this week.
Absolutely. But as we mentioned, you know, the signs that the two sides in Washington, Democrats, Republicans, are speaking was enough to bring indexes into the green, at least the S&P 500 and the Dow by the end of today. You do see gains of just 0.2% for the Dow Industrials, and for the S&P 500 up 0.1%. The Nasdaq still lower by 0.2%, showing that pressure from big tech.
I just want to know, are they going to the round robin bar in D.C. and actually having, you know, a martini and saying, guys, let's hash this out?
I don't think so.
I don't think so.
I don't think that's how it works anymore.
All right, so let's get to the S&P 500, folks, now that we are at the close. In terms of the market averages, Christine, we're looking at more names actually higher today. It wasn't that way earlier in the session. 389 names in the S&P 500 gaining ground on this Friday. 112 to the downside, 2 unchanged.
Well, Carol, I'm looking at the sectors again that have led us and lagged us in this equity session. I mentioned earlier, Infra Tech, of course, biggest loser today. But, you know, the biggest winners, energy sector. Look at that. So that is up, currently being led by Exxon. We're all seeing, of course, oil prices up today. So, you know, that's kind of helping cushion some of those declines in the S&P 500 that we're seeing earlier. And again, as Carl mentioned, you know, we've paired some of those losses already because of potential hope that we might see the beginning of the end to the shutdown if we do, in fact, see our lawmakers grabbing some martinis somewhere in D.C. this weekend.
Yes.
One can hope. What are the odds?
Something like that, right? All right, so we can keep our fingers crossed. Hey, so a lot of green. So let's get to some of the individual gainers. Got to mention Expedia. It's your number one gainer in the S&P 500. The stock finishing with a rise of about 17.5%. It is now up about 40% year to date. The company raising its full year gross bookings and revenue outlook. It signaled that strong travel trends are continuing into the holiday quarter. So revenue this year now expected to increase 6.5% at the midpoint. Gross bookings are expected to grow 7%. That's both ahead of estimates and Expedia's previous guidance. I should point out the outlook does not take into account the U.S. government shutdown, and the company has yet to see an impact just over a month in, according to the company's CEO. All right, over to Monster Beverage we go. This one, number two gainer in the NASDAQ 100, a gain of 5.2% here after the energy drinks company's third quarter results topped expectations. Analysts pretty positive about the company's gross margins and sales following the recent price hikes. And this one, too, is up about 32% here in 2025. And one more for you. We're talking about Top Golf Callaway. That one up about 14.3%. Yeah, right? I guess people are golfing.
Yeah, I guess.
Remember we thought
it got revived during the pandemic, and it has like been building on that since.
Exactly. So again, a good number here. The company came out, boosted its net revenue guidance for the full year as football fans took some extra time out for golf. Glad to hear that's happening. The company expects annual revenue of $3.92 billion at the midpoint. That's up from the previous expected $3.86 billion. This was also above Wall Street's estimate of $3.89 billion. Stock up more than 30% year to date. About 10% of the float is short. But I've got to say, that's kind of how I grew up. My family went from golfing to football. Golfing to
It's
football.
good to get up from the couch every once in a while and practice a swing.
They did go out and play a lot of golf, I should say that. So they at least did get off the couch on that one.
Hey, you got the gainers, I got the decliners today. I want to start with shares of the meat processing company JBS falling 3.64%. Shares just dove late in the trading session at about 3:38 p.m. This after the president said in a social media post that he's told the Justice Department to probe meatpacking companies. Here's what the president said in part, quote, "I've asked the DOJ to immediately begin an investigation into the meatpacking companies who are driving up the price of beef through illicit collusion, price fixing, and price manipulation. We will always protect our American ranchers, and they're being blamed for what is being done by majority foreign-owned meat packers," end quote, in part. He goes on to say more. We should note there are a host of reasons why beef prices in the United States have gone up. We've typically imported quite a bit from Brazil, but then tariffs on Brazil helped put an end to that. We were hoping, well, the U.S. was hoping to import from Argentina as well, but that's politically difficult when it affects the price of beef for American ranchers, many of whom did support the president in his last election. Once again, shares of JBS down 3.6%. We'll continue following this story. Also among the worst performers in the S&P 500 on a percentage basis, shares of the company formerly known as Square, now called Block, down 7.7%. The company did raise its full-year profit forecast and posted strong growth in consumer banking, though its third quarter revenues fell short of Wall Street's estimates. The company added 300,000 new primary banking users in the quarter, and the number of monthly active users in the Cash App ticked up slightly to 58 million. Also, finally, Sweetgreen shares hitting a record low today, down 7.5%. The restaurant chain cut its revenue guidance for the full year. It missed the average analyst estimate. Red Brown, a consumer reporter for Bloomberg News, has a great piece out on the terminal today. I encourage everybody to go read it. It's about how the pricey menu add-ons that were added over the last few months have misfired. The Ripple fries that were made with hand-cut potatoes and air-fried in avocado oil were removed from the menu just after 5 months due to being too complicated to make, and they were not popular.
Isn't Ripple a really bad
with consumers.
Huh? Isn't Ripple a really bad drink?
I don't know the drink.
I think so. All right.
Okay.
Sweetgreen and fries just are a strange mix overall, you know?
Weird.
All right, quick glance at yields. You could see little change right now. They were up, they were down, they're up again, and now they're kind of, they're just all over the place. But we do have a big week in terms of issuance next week. $150 billion of 3s, 10s, and 30s, which will be shortened next week because of Veterans Day. So there's a lot of supply to absorb next week. Just something to keep in mind here because there's no official data that we're dealing with right now. We also have headlines coming out with Israel's outlook revised to stable from negative by S&P. And so if you look at the Israeli shekel, the dollar sinking to its session lows versus that currency. So the shekel is at its session highs in terms of strength. The dollar's at its session lows versus the shekel. So we'll continue to keep an eye on that. Carol?
Oh, thank you so much, Scarlett. Hey, let's get to some stories that definitely have caught our attention. So as we are in the longest government shutdown, 38 days and counting, we'll see whether or not, like we did see some movement today, but we'll see whether or not it comes to an end sooner rather than later. We are looking at different statistics to figure out what's going on in the economy. And here's an interesting story. A slump in cardboard box sales stoking fears of weak holiday retail shopping season. U.S. corrugated box shipments fell to the lowest third quarter reading since 2015. This is according to data from the Fiber Box Association. Yes, there is one. Packaging companies have warned that economic uncertainty is weighing on retailers and consumers, with box plants reporting, Tim, flat or below normal orders in the month of October.
Yeah, so shipments of corrugated cardboard can serve as a demand indicator for food and consumer goods. This time of year, though, critical for the box industry because shipments typically peak in October as retailers prepare for the holidays, so it gives us a good idea of, or potentially could give us a good idea of what demand could look like in the holiday season.
All right, well, Tim, over here on the closed studio, we're taking a look at this Target story. So apparently they're now asking their workers to smile more. I'm not sure whether
they have rules for them. That's
apparently,
a thing.
Yeah, they have targets for how much they smile. But this is the whole strategy that they're leaning into now, which is apparently Minnesota nice, right? Given that they are based in Minneapolis. But basically, the idea is that for workers, if a shopper comes within 10 feet of them, then they have to make sure that they smile, make eye contact, greet, and wave. That sounds like a nightmare for me, personally.
I think it actually comes really easily for you, Christine, but it's really interesting because it's just like the Starbucks baristas having to write inspirational messages on people's cups when they order something to go, or if you guys are devotees of the movie Office Space, remember the pieces of flair that everyone has to wear, the 15 pieces of flair versus the 37 that Brian had because he was such an enthusiastic worker?
I love the reference, Scarlett.
Does everyone know it?
Yeah,
yes, absolutely.
I'm going through a litany of lines in my head that I could not say right now, but yeah, you know.
The Bobs.
Everyone knows them. Everyone knows the Bobs.
All right, good stuff. And some interesting stories. Hey, guys, have a great and safe weekend. That is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Christine and Scarlett, of course, continuing there on The Close on Bloomberg TV, and Tim and I continuing on Bloomberg Business Week Daily on Bloomberg Radio. Have a good and safe weekend, everyone. We'll see you on Monday.
All right, we've got much more coming up on The Close here on Bloomberg Television. America's longest government shutdown now extending into the weekend. We discuss what's next with Henrietta Treyz, Director of Economic Policy at Veda Partners. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close on this Friday. I'm Scarlett Fu.
And I'm Christine Aquino.
All right, let's take a look at where things stand here at the end of the trading day. At one point, the S&P 500 fell below its 50-day moving average, but the buy the dippers came back in, and we closed just above that level, up 0.1%. You are still seeing pressure in the NASDAQ, though. That's down 0.3%, but at one point, it fell as much as 2.1%. Earnings season definitely winding down. Investors now returning their focus to the macro environment where we are in a data vacuum. The VIX has eased off too. It did go above 22 at one point, but still well below where we've seen 3 weeks ago when it was at 28. But it has also eased as we got closer to the closing bell, and Treasury is not doing much of anything. A lot of supply coming in next week, $150 billion of notes and bonds, which will be shortened next week, by the way, because of Veterans Day on Tuesday.
Wow, a holiday that we do not get.
The bond market's closed. The stock market is not.
We'll still be here, though, so don't worry about that. But all right, well, there is a lot moving in the equity markets today, so let's dig into some individual movers here. Of course, we have Sweet Green. That stock plunged to a record low. That is now below $6 a piece because the restaurant chain cut its revenue guidance for the full year and missed estimates because apparently 20-somethings aren't buying salads anymore. So go figure.
Too expensive.
Yeah, too expensive. All right, we also have Block. That is a fintech platform, and of course that is also falling after third quarter adjusted earnings and net revenue missed estimates. And you know, all of those headline numbers overwhelming the fact that it did boost its full year profit forecast and also saw strong growth for its Cash App unit. Now, Expedia is a stock that is doing well today. Some silver linings for you on this Friday afternoon. It is set for its best day, or saw its best day since 2020 during the peak of the COVID pandemic. Big rally there. That's because the company raised its full year outlook. And of course, the CEO, Erin, pointing to a combination of their performance in the third quarter as well as momentum that they're seeing in October.
All right, well, let's see if those gains in Expedia last into next week. Our top story this hour, signs that the longest government shutdown in history is now pressuring the economy and markets. The University of Michigan's consumer sentiment falling to a more than 3-year low, while currency investors on course for the poorest annual performance since 2005. This as more than 700 flights were canceled today by the 4 biggest U.S. airlines as Senate Republicans rejected the Democrats' latest offer to scale back demands. So let's bring in Bloomberg Balance of Power co-host Joe Mathieu. Joe, I was saying earlier that the silver lining here is that the two sides, Democrats and Republicans, are talking to each other, but maybe I have that wrong. Are the aides talking to each other or the leaders talking to each other?
There's some rank and file lawmakers talking, and that's been the case for weeks here, but it doesn't mean that we're making a heck of a lot of progress. If you liked day 38 here, you're probably going to love day 39 because I'm not sure anything is going to change in the next couple of days, guys. They were talking about staying for the weekend. That may be going out the window right now. We're trying to keep tabs on conversations that are underway on Capitol Hill with John Thune in a position now just to send everybody home because it looks like we're going nowhere. To your point, Republicans just rejected, and we can really kind of frame this more as dead on arrival. A plan from Chuck Schumer to pass a continuing resolution and also extend Obamacare subsidies by 1 year. Democrats had been looking for a permanent extension, and he suggested they could sit down and talk about that after the fact. That was an immediate no from Republican leader John Thune, who says you got to reopen the government to have this conversation. And I'll tell you guys, we opened the day here with a bit of optimism. There was a thought that there'd be a vote tonight on a continuing resolution coupled with a couple of bills that had money for food aid and for veterans. That is apparently going out the window now, too. So we're looking at this evolve in real time.
Yeah, well, it seems like the outlook is really bleak here, Joe. And, where could we find the daylight here in terms of the two sides of finding some sort of a reconciliation? Because, as you mentioned, the Obamacare subsidies, a no-go for Republicans. But are there other issues that we could potentially see some sort of compromise between the two sides?
Well, I'll tell you what, the Obamacare subsidies are not necessarily a no-go for Republicans. They just want to see the government reopen before they have that conversation. So stay tuned for that part. But to answer your question in terms of where we might see daylight, I guess it's darkest before dawn at the airport, because you just mentioned more than 700 flights. They're going to be cranking up the pressure every day with another 1% of flight capacity removed until we get to 10% on Wednesday. Sean Duffy saying in an interview today that could go up to 20% if the shutdown persists. How many weeks are we from Thanksgiving? I just don't think senators are going to be able to allow that to happen. That would essentially grind commerce and life to a halt.
All right. Bloomberg Balance of Power co-host Joe Mathieu, thank you so much for joining us in Washington. And of course, be sure to tune in to Balance of Power at the top of the next hour. Now, we do have a headline here from President Trump. He's commenting in a Truth Social post saying that the Senate should not leave town until a stopgap deal is reached. So again, the president encouraging the Senate to stay in town and to not adjourn for the weekend until they reach some kind of compromise. Our next guest believes that the government is on track to reopen next week. Henrietta Treyz, Director of Economic Policy at Veda Partners, joins us now. Henrietta, how do you see it playing out where we might get some kind of government shutdown resolution next week?
Well, I'll get super granular with you. First of all, this is an excellent comment from the president. We really do not want to see the senators leave town. As Joe was just talking about, if they head out, we could be shut down all of next week as well. So the fact that the president is getting engaged now at, whatever time it is, 4 o'clock, is really constructive. I'm hopeful that the senators will stay in town. They will go to their, fundraisers and cocktail hours for the next hour or two. And then later on this evening, 6, 7, 8 o'clock, you should start to see a flurry of activity. Another, volley across from the Republican side, another from the Democratic side. I have consistently refuted this idea that it's going to be just a trickle of Democratic senators who cross the aisle to side with Republicans. This is going to be, a 70, 72, 75 vote count final threshold. So they all need to get together. They need to form some sort of cohesive unit that will call the House back on Sunday. They'll get in and vote on Monday. There's a path to reopening by Tuesday, Wednesday at the latest.
Who's resisting more right now, given the election outcome that we saw from this week, where Democrats swept most of the important races?
Yeah, and the Democrats swept in the most convincing of fashions. They didn't just increase their turnout versus, say, 2018 or other off years. They flipped Trump voters. They flipped Latino voters. They flipped young men. All the folks that Republicans have attracted over the last couple of years went completely the way of the dinosaur and went back to the Democratic conference. So that's something that the Democrats feel has given them the upper hand. And I think you can see from the president's, brand new engagement in this topic suggests that he knows that the shutdown is a losing issue as well.
Well, so Henrietta, our very own Joe Mathieu, of course, talking about how, it's darkest at the airport before dawn, right? And the pain being inflicted on regular Americans possibly going to be the pain point here and maybe the turning point for both sides to come together. But, in that strategy, who do you think loses if, the perception among Americans is that, we had to withstand so much hassle traveling and, SNAP food benefits getting cut before they found a resolution. Which party do you think will suffer most from that strategy?
You know, I don't think it's really much of a question anymore because it's been so consistent for the last 38 days of the shutdown. In the initial stages, Republicans were blamed about 6 points more than Democrats. That has consistently widened. It's now 8, 9, 10, and at the highest I've ever seen is a 14-point disconnect between Republicans and Democrats. And what's really interesting to me is just in the last, I think, week and a half, 2 weeks, polling has started to suggest that the president is more at blame than the Congress is. That's a new development. It was at the original stages mostly blamed on the House and the Senate, but now the White House is taking the brunt of the blame. It's only by a few percentage points, so nothing to get bent out of shape about, but definitely the reason why the president is engaging now. He plainly needs to instruct the Republican conference about what they can and cannot do. Democrats have finally come to the table with some offers, so we should see some movement here and shake it out. Republicans are going to get blamed for it. That's been the case for all of the month of October and now into November. But the election's not for a year. So hopefully by then voters can pull their jets and objectively look at these guys and see who they want in office.
Yeah, well, you know, the economy does win elections, right? And according to some estimates, the U.S. economy is losing about $15 billion each week that we go into this shutdown. How do you think that's going to play out longer term for both parties in terms of their strategies to try and, you know, leverage this somehow for the next election cycle?
Yeah, the economy, inflation, and prices are the top three issues facing U.S. consumers by a country mile. Healthcare is down in the single digits. Immigration is down in the single digits. It's all about the economy. And these disruptions are not just economically disruptive for the military, for furloughed employees, 700,000 of those folks across the country. It is very problematic for anybody trying to make a plan to travel for Veterans Day, to travel for Thanksgiving. You're uncomfortable. I know I am. I got to get to Florida. I'm not hopping a plane. You know, so this is definitely disruptive and creates uncertainty. You can see it in McDonald's stocks, Dollar General, Walmart. You can see it everywhere.
Yeah, way to link it back to markets because that's what we're seeing day in and day out. Henrietta, always a pleasure speaking with you. Henrietta Treyz, Director of Economic Policy at Veda Partners. She does see the prospect perhaps for some resolution next week. Coming up, this shutdown resulting in hundreds of flight cancellations today and more tomorrow through the weekend. We're going to get a check on the ground from Newark Airport with our own Norah Mulinda. This is The Close on Bloomberg.
If this shutdown doesn't end relatively soon, the consequence of that is going to be more controllers don't come to work, and then we're going to have to continue to assess the pressure in the airspace and make decisions that may, again, move us from 10% to 15%, maybe to 20%.
U.S. Transportation Secretary Sean Duffy there on Fox News saying flight cuts could worsen if the shutdown drags on. Let's go now to Bloomberg Markets correspondent Norah Mulinda, who has been at Newark Liberty Airport all day long. Norah, give us a sense of how the traffic has progressed throughout the day today.
Well, Scarlett, I'll tell you right now, it does seem as though foot traffic at Newark Liberty Airport is tapering. We have seen some fluctuations throughout the day, really high volume at the earlier part of the day, but we are seeing that slowing down just a touch. But as we're talking to people here on the ground, of course, the concern is clearly the government shutdown and the delays and the disruptions that it's causing here as we think about a lot of the airlines, a lot of the flights going on heading into the weekend. But of course, what still remains on top of mind for a lot of travelers is whether or not this is going to drag into the holiday season, which we know Thanksgiving just around the corner here. So we do have a lot of TSA workers. We also have air traffic controllers that are also in focus during this time period, given the fact that they have not been paid since October 1st, once the government shutdown began here, Scarlett.
Yeah, well, Norah, now know that we have more cancellations flowing through. What's the general vibe from the people that you've spoken to? Are they mostly just focused on trying to make their flights? Are they worried about all the potential safety issues, given the lack of just airport workers in general and air traffic controllers?
Well, it's really important that you brought up safety concerns there, Christine, especially given the fact that we do know that the FAA said that about 20 to 40% of air traffic controllers at major airports in the U.S. are failing to show up for work. So, of course, that brings concern on the mind of consumers, travelers during this time period. As I've been talking to people here at the airport throughout the day, of course, a lot of people are trying to get to their flights early. They want to beat any sort of disruptions and make sure that they are aware of what's going on moving forward here. But it really is about whether or not we start to see this ricochet ricocheting or actually continuing here into something more catastrophic than what's going on right now, because right now we're only seeing about a 3% cut, a 3% cancellation here for U.S. Flights in the U.S. So this is not as catastrophic as a lot of people intended it or assumed that it may have been, but it all depends on what this will look like moving forward and how long it will last.
All right, Norah, Mulinda, thank you so much for doing yeoman's work over at Newark Liberty International Airport. Nora's been there all day long, kind of tracking the foot traffic there, tracking the delays. And of course, Christine, for the people she's talking to, they want to get to the airport early and make their flight, but then they have to worry about their return flight as well. And that's the bigger question.
Yeah, absolutely, Scarlett. You know, I was in the exact same position last week because I went to Spain last weekend and was worrying about the exact same thing, you know, because my flight was only an hour delayed, so that was fine. But then coming back, I was like, oh no, is this going to get worse?
Yeah, well, hopefully we'll get some kind of resolution and people can get back to work. People can get paid and get back to work. All right, coming up on the close, will AI's circular deal-making spin the industry forward or perhaps spiral? Wedbush's managing director of disruptive technology, Rick Sherlund, joins us next to lay out the risk-reward dynamic. This is Bloomberg. The U.S. and China are in a two-horse race to dominate the generative AI game, not doing much to stave off allegations of a brewing AI bubble as NVIDIA and the hyperscalers spend billions of dollars on the build-out. Joining us now is Rick Sherlund. He is Managing Director of Disruptive Technology, Media, and Sports Investment Banking at Wedbush. Rick, a pleasure to speak with you. And I feel like last week, we really started to see the AI enthusiasm shift maybe into AI skepticism. What's the question that investors are now asking that perhaps they weren't before?
Yeah, I think the catalyst was a podcast, the BG2 podcast, where Sam Altman was asked a question whether they could afford to deliver on all the capital spending projections and commitments that they've made. And that's an issue it's kind of been around in the market all week. It spooked the market a little bit because I think Brad Gerstner today was saying that the commitment's $1.4 trillion over the next 5 years or so. Sam Altman was, scoffing, saying we'll do over 100 billion soon, and that implies that the company is going to grow so fast that demand is going to continue to exceed supply. We just need to find a way to make sure we've got the power and the money to fund the data center expansion that's required, because AI is just really getting started in the enterprise space, and the inference that's going to be required by every company to improve productivity will be significant. So I think there's not a question about a bubble in terms of demand. The demand is there and is just really kind of getting started, particularly in the enterprise space.
Right.
I think the issue will be, how do we get the funding? And I think we'll find the funding will be available to us because there's off-balance sheet ways to fund this. The debt market, is pretty deep. So I think we'll be okay, but it did deflate valuations a bit this week.
All right, so that question of who is going to provide all the funds needed to finance OpenAI spending, and we've seen OpenAI sign deals with, it seems like, every big tech company listed on the NASDAQ. And you mentioned the off-balance sheet funding, including special purpose vehicles. We've seen Meta do something like that. Is that concerning when they start to move into those SPVs?
Well, I think we're at the very early stages, and I think companies need creative financing to try to come up with some assurance that they can provide the capacity that's required. You've seen OpenAI expand their relationship beyond Microsoft to include Oracle and others. So I think everyone's concerned about getting the chips that they need, getting the data center capacity, getting the power that they need. So I think of it more in terms of just growing pains. I know people have been concerned about the circular nature of some of the funding. That's something that we've seen in the industry before. I think the capital markets are pretty deep. So to the degree that companies can access debt markets, and I think we just saw Oracle doing that in a pretty big way. There's a lot of capacity in the debt market. This is a very high growth sector of the economy, and I think it'll get the capital that it needs to continue to grow, because every company in every country globally will need AI to improve productivity is critical for economic development globally.
Yeah. Now, Rick, of course, you mentioned power as one of the potential constraints, right, in this whole trade. And we have seen power providers really struggling to keep up with the demands of all these new data centers that are popping up. What do you think are the opportunities here? You know, is this something that could potentially provide a short-term hurdle to the AI trade? And who do you think will be best placed to overcome them among the companies in the AI space?
Well, we have lots of natural gas. You got to make sure you can get it to where it's needed. Gas turbines, I believe, are out of capacity for several years now. So I don't think it's so much of a concern for the next year or two. But I think looking forward, we're going to have to come up with more sources of energy, whether it's coal or nuclear. But there are some significant concerns about whether we can continue to provide the power that's required. And I worry more about that than the funding. I think that power ultimately is going to be a critical constraint for ongoing deployment of these data centers.
Yeah, and from the investor's perspective, of course, we've seen kind of the cycle of the AI trade move initially from the biggest of the giants, right, the Magnificent Seven, and then eventually moved on to the makers of the chips, and then the companies who, the picks and shovels companies, the companies who can build the infrastructure. Where do you think is kind of the next trade here in terms of the overall AI theme? Is it really going to be with the utilities, perhaps, given that power is so in demand at the moment?
No, I think that's been the case. The infrastructure, as you move up the stack into the software layers, we've seen the data, anyone with data, that's a real critical asset for AI. AI requires a lot of data. Infrastructure has been a relatively safer and exciting place to be in software. The applications layer, there's been more concern, I think, on the applications layer because the workflows, the processes that are inherent in every business are changing because we now have the ability to leverage AI to create new processes, streamline operations. So I think that is the next big area. And the question would be, are there AI native software companies that are reinventing the wheel, or can the traditional applications companies bolt on and reinvent their business around AI? And we've seen a couple of examples where firms have been successful in repositioning themselves around AI, and the stocks have benefited dramatically. So I think there's an opportunity. And one of the things that I'm interested in, I have my own firm, Sherlund Partners, and we partner with Wedbush. But one of the reasons I'm excited about this, not only are they very focused on disruptive technologies, as I am, but I'm interested in asset management as well, because I think there's an opportunity for a lot of those software companies that sell at very steep discounts to where they used to sell at. If they can reinvent themselves, if we can source and diligence those names, I think you have an opportunity for asset management here for this sector to come back very significantly. But it's very company specific. But the applications layer is the next layer where companies begin to roll out AI in the enterprise, and we haven't seen that broadly just yet.
Rick, I want to ask you about Tesla because we talk about circular deal making, and it strikes me that Tesla kind of is going its own way. It's not involved in any of those deals, as far as I know, with OpenAI or NVIDIA in the way that the other Mag 7 names are. But we did learn at the shareholders meeting that it will start making some of its own semiconductors, and Tesla now has the path to perhaps invest in XAI. Is that a good thing for the company?
Yeah, so I'd have to leave that to Dan Ives and the analysts that cover that sector. As an investment banker now, after being a research analyst for many years, it's hard for me not to talk about stocks. But as an investment banker, I really need to stick to my industry expertise and not company. Sorry.
All right. No, appreciate your listening to it anyway, regardless. Thank you so much. Rick Sherlund is Managing Director of Disruptive Technology, Media, and Sports Investment Banking over at Wedbush. Much more coming up. This is The Close. U.S. consumer sentiment slumping to a 3-year low as the government shutdown drags on. There's been pain for the average consumer, but what about the aspirational consumer? Our next guest offers a unique perspective from his seat as co-founder and CEO of REKLAIM. It's a pre-owned luxury platform. I'm pleased to say he joins us now. Razavi is the co-founder and CEO of the company. Cam, good to speak with you. Just explain what REKLAIM does. What is your specific role and where does it sit in the luxury resale market?
Sure. We look at ourselves as a giant recycling plant, I guess you could say. We aggregate and put through our proprietary data and tech platform $10 billion worth of luxury pre-owned timepieces and handbags per year. And then in our current business model, we are distributing through large corporate retail partners like Nordstrom, Signet, Dubai Duty Free, and a number of others that give us access to, right now, 200 points of sale around the globe.
And my understanding is consumers cannot sell their goods through your platform. They can only make purchases. So I'm curious why you're choosing that one-way service. Would you ever open up to buying pre-owned goods from consumers?
Great question. And when we first started the company, the focus was scale. So to create this model at scale, we are not currently procuring off of the public. And it's something we might do later on in the business model in the future. But it gives us greater efficiency and cost efficiency to distribute these pre-owned luxury goods through corporate retailers, which is something that really hasn't been done before at scale.
Now, Cam, I want to speak about your partnership with Amazon as well. Very interesting there because, you know, just a few years ago, you wouldn't necessarily expect aspirational consumers to be purchasing luxury watches like a Rolex off of Amazon, right, and getting next day delivery.
Right.
But how have consumer attitudes toward that space changed? And, you know, is the convenience something that they prioritize more over the prestige?
Right. And I think, you know, Amazon has done an amazing job globally to shift the consumer sentiment to a prime service of access. And that's really one of the fundamental items that was behind REKLAIM, is to provide access. So in partnering with Amazon as a trusted retail brand globally, we're able to provide a larger customer subset with access to our products at scale.
Yeah, and what sort of customer trends are you noticing, or do you expect to notice with this partnership? You know, do you think that you'd be able to get access to perhaps consumers that are maybe new to buying luxury? You know, they've just started earning a whole lot more and wanting to get into these goods, perhaps?
Yes, we break it out into two categories. It's customers that are looking for a better price or a value on goods, and then customers who are looking for access. So with many of these luxury goods, Rolex, for example, which represents 70% of the pre-owned watch market, you usually can't go into a Rolex boutique and get exactly whatever you want whenever you want it. So that's one of the solutions that we provide. And one of the core focuses of the partnership with Amazon is in the pre-owned luxury watch space.
You know, I wonder if there's a ceiling to demand for luxury brands from the high-end consumer. And I ask this because there was a Wall Street Journal article about how demand for new luxury goods has been flat on average for 6 straight quarters among the top European brands. So when purchased new, demand has been flat. But you look at demand for used luxury, for previously owned luxury, and that has been growing really well, and as evidenced by your business platform as well. What does that say about, you know, the natural limits of the luxury market?
Yeah, it's a great point, and you know, you kind of have two different markets. You have the original market selling to the consumer, and then you have the second-hand market. That Boston Consulting Group just came out with a great report citing a growth statistic of $360 billion by 2030 for the pre-owned luxury market. So what we aim to achieve as a company is expand the optionality for the consumer to be able to have access when they're looking for a lower price point, Generation Z and many others who are just stepping into luxury or a luxury purchase for the first time. And then those collectors who may want something specific and want that access. And really, we trademark the term whatever, whenever for pre-owned luxury goods. And to have that experience to get whatever they want, whenever they want it. They don't need to wait a year. They don't need to wait 2 years or 5 years. If they want a timepiece for a special occasion, they can buy it directly through us anytime.
And Cam, talk to us more about your approach to conscious luxury, right? Because even in this segment, we have seen an increased emphasis on being more sustainable. And so how does REKLAIM kind of take advantage of that?
Yeah, so when we started the company, one of the driving factors for me and my co-founder, Jamie Thomas, was to create a win-win-win for retailers, for the planet, and for the end consumer. And the way that we operate and have built REKLAIM with this focus on data and technology, we really believe that we've achieved that goal and now are expanding it globally. And you know, at the end of the day, we only have so many resources on this planet that was gifted to us. And we believe as a company, it's our responsibility, if we can pull it off, we believe we can, to show people that, you know, when you can build a company that can basically extend the life cycle of a product that is coveted, we want to try to do that. And we want to work with customers. And we recently partnered with Elsa Hosk, who has a similar mentality when it comes to curating this conscious collective of individuals that embody that. And she put together a great collection of goods that are available on Amazon with us as well.
All right, Cam, thank you so much for joining us. Good luck to you. Cam Razavi is co-founder and CEO of REKLAIM. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Cornell University President Michael Kotlikoff, the Ivy League school reaching an agreement with the White House to restore about $250 million in federal funding.
Yeah, well, that's interesting, Scarlett, because it looks like as part of the deal, Cornell has agreed to invest $13 million over 3 years in agricultural research. A very interesting agreement there, right? It's probably definitely interested the White House, part of the White House's.
Yes, and pay $30 million directly to the U.S. government as well, which is what I think President Trump was looking for. What are you looking at?
Well, we are looking at Elise Stefanik, who is the representative from New York, announcing that she is running for governor against the incumbent Kathy Hochul. Very interesting.
Yeah, and of course, she's been considering making a run for the governor for a couple of months, and it wasn't until Zohran Mamdani won the mayoral election that she's decided to come out. And she's been on radio, like making statements about calling Hochul, you know, the worst governor in America, just as part of her, I guess, winding up her campaign pitch. All right, let's talk about who's third on the docket, and that is Kendrick Lamar, the rapper, I should say, earning 9 Grammy nominations, leading all the artists.
Well, and you know, he also has the accolade of bringing back the flare pants.
Oh.
That's part. We should add that to his list of achievements.
So 9 Grammy nominations and bringing back flare pants.
Exactly.
All right, I like it.
All right, we have another person that we're watching. It is WNBA Commissioner Cathy Engelbert, who finds herself at the center of a dispute over how much to pay the league's players. Joining us now is Randall Williams, Bloomberg's U.S. sports business reporter for more. Thank you very much, Randall, for coming onto the show to talk about this. So lay out what the two sides want for us. You know, what does the WNBA and Cathy Engelbert stand for, and what do the players want from them?
Sure. So Cathy Engelbert has said she wants a fair deal. Now, in that fair deal, what myself and Aisha and Jenna learned is that she's planning or would like to triple the salaries. And both sides have said that the players are going to be paid more. But the real question is, how are they going to be paid more? And so in reporting this story, we found that the union is asking for between 30 to 40% of revenue sharing between the league and the teams. Now, that number could change over time depending on how they negotiate things, but that's the basis. And there's a philosophical difference as for what the league wants and what the union wants. The union wants rev sharing, and the league has said that they're open to rev sharing, but the exact terms are still being determined.
Yeah, well, full disclosure, I am a New York Liberty season ticket holder.
Okay.
I've been to most of the games this past season. Every night that I was there, that arena is packed.
Absolutely.
Right? A lot of fans just pouring money into this league. And so when it comes to revenue, I guess it's understandable that players want to share in that. But it seems like the league is unwilling to. I think some of their positions is that, you know, they can't afford that. But how do they even justify that stance?
So that's one of the biggest issues in this negotiation is the transparency side of things. If there was something that the union was looking at and it said, hey, you know, if we do what you're asking us to, then it's going to compromise the league, then I'm sure the ladies of the WNBA would be like, okay, you know, let's strike an agreement that's a little bit more fair, so to speak. But I don't think that the union is seeing that at this current juncture. The league isn't going into these negotiations and opening up their books and saying, hey, here's all the finances of the league, let's find terms of the deal. And so with that in mind, the league's keeping their leverage, and the players are threatening, like, okay, if you're not going to strike a fair deal, then we're willing to negotiate as long as we can until we find something that we like.
Yeah, the setup does not create a lot of trust between the two sides, especially because what we know publicly is that Cathy Engelbert has done a great deal to increase revenue. She's struck deal with corporate sponsors. They're going to expand the league and bring in new teams, which always means more fees from the new expansion teams.
Yes, I mean, the WNBA has grown. Cathy Engelbert is directly responsible for some of the success of the league. The players, of course, are responsible for that as well, but Cathy has brought in dozens and dozens of corporate partners. If you look at the expansion fee alone, a couple of years ago, it was $50 million. These 3 expansion franchises that were just sold earlier this year were sold for $250 million. And so she deserves credit from that. But at the same time, if you have to look at her complete tenure, there are questions about culture. There are questions about her ability to build relationships with its players. It's one thing to get on the podium and say, hey, negotiations are going well. We had constructive conversations. It's another thing for 30 minutes later for players to come out and say, pay us what you owe us.
And of course, they struck this really attractive media deal as well. That was very lucrative. Let me ask a really dumb, maybe complicated question.
There's no dumb questions.
What is the role of the NBA here and of the NBA commissioner Adam Silver in all this?
Well, Adam Silver has said he's going to stay out of this, but he's also, quietly backed Engelbert's positioning, and he said that in NBC News. He said that on the Today Show as well. When he was asked, should the players be receiving more revenue, he said yes, but sharing isn't the way that they should look at it. They should look at it in absolute numbers. And so what that means exactly, we'll find out when they agree to a deal. It's only a matter of time. Whether there's a lockout, whether there's a strike, whether they agree to yet another extension, they will eventually come to terms. It's just about when.
Is the NBA a partner? Do they own any of the league?
The NBA partially owns the WNBA.
Okay, got it. Randall, thank you so much. And of course, you'll keep us up to date on all of this. For Christine, the New York Liberty superfan sitting next to me, Randall Williams, Bloomberg's U.S. sports business reporter. All right, let's look ahead to what else we're watching over the next week. There's no economic data because the government is still shut down, but there is going to be plenty of Fed speak.
Yeah, a lot of Fed speak, Carly. And we're going to have Fed's Mulinda joining us here on Bloomberg. And of course, we want to probably hear about what they're thinking in terms of December rate cuts there.
Absolutely.
Right?
And then we've got earnings. I mean, the bulk of earnings season is over, but we do hear from Paramount, Skydance, CoreWeave, which is another good read on the AI market, and Instacart, which still trades officially under Maple Bear, right?
Mm-hmm, that's right. Yeah, and we're also looking on Tuesday. That's going to be the world's largest shopping day, China's Singles Day. Wow. I don't know if I'm going to be doing a lot of shopping since that label doesn't apply to me, but good for all these people.
Well, the deals are there regardless. UK jobs data is set to be released. Plus, we should mention the bond market is closed for Veterans Day. On Wednesday, Scott Bessent, the Treasury Secretary, and John Williams of the Fed will be speaking. The European finance ministers meeting in Brussels. There's also some earnings coming up on Thursday from Disney, Tencent, and JD.com. Also, on Friday, we have Eurozone GDP data.
That's right. Well, Europe has data because their government is not closed, so we'll look forward to that as well.
That does it for us. Bloomberg's Balance of Power is up next. Have a great weekend.